My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Chris Weston. Chris, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets, and where are you located?
Yeah, hi. Good to be here and a pleasure to be asked. Yeah, I'm located in Melbourne in Australia. Nice and sunny at the moment. Obviously disappointed that Biden's not going to be making its way out this way anymore. But yeah, my role, I guess, I work for a company called Pepperstone. I guess my role is slightly different from most analysts. It's really sort of trying to identify the market environment by which people are trading in, trying to help them with their understanding of the volatility regimes that we're in, the sort of range that we're in, what sort of strategies are working best in that trading environment, whether it's sort of mean reversion, trend, momentum, all those factors, obviously depending on the time frame that you're looking in. But really trying to understand event risks that are coming up, where the skew of those risks lie, and help them with their sort of understanding of probabilities. So slightly different from your sort of traditional analyst. It's really sort of trying to get the sort of nuts and bolts, the connection with trading and the financial markets, more to sort of a trading environment of clients there. Prior to Pepperstone, I sort of cut my teeth in investment banking. I worked for Merrill Lynch, Credit Suisse, back in London, and also for Morgan Stanley as well. So I've done a bit of sell-side roles, and also with Merrill Lynch investment managers on the buy side of things, so as a fixed income trader there. So done a bit of everything, but now sort of find myself in Melbourne working for predominantly a retail shop.
So I was looking at some of your tweets with videos of you talking about markets, and if it weren't for your accent, I would have assumed that you're in the U.S. only following U.S. markets, right? But you're obviously in Melbourne, Australia. Talk about for the audience, I know it's a kind of a cliche, but this idea that global markets really are just following U.S. markets. How important is tracking the U.S. to somebody that's in a whole different part of the world?
It's everything. I mean, at the end of the day, the Fed are the world's price maker, aren't they? And you've got a lot of the other central banks which have some sort of idiosyncratic factors on domestic markets, but ultimately, it's the Fed that dictates a lot of what happens in global policy. I mean, we can talk about what happens in China and other facts as well, but I think we watch what happens in US markets when we come in, that sort of to the lead in from the S&P sort of feeds through into our local equity market, and SPY futures trade on that overnight. But generally speaking, the majority of our clients trade the G10 currencies. Obviously the dollar's a massive part of that. Big traders in gold, what happens in real rates, and the US dollar obviously a big part of that as well. So I think in terms of what we do in terms of the business and clients activity, it's very much US centered in that capacity. Obviously, there's some individual opportunities on local markets, but I think the US is you've got to keep an eye on what's going on in the US. It really sort of controls the narrative, and as we go into the debt ceiling, other factors that's going to play a part, and we're all trying to understand a lot about the political situation. Obviously, you guys live and breathe it, being there, and it's kind of wall to wall, and it's going to get perhaps even more deafening over the next couple of weeks. But we're trying to understand the likelihood of that playing out into a volatility event. What are going to be the triggers? We all know there's volatility potentially there, but we're looking for the signs, and therefore we sort of even though we're based in Australia or in the UK or wherever we're going to be, we're trying to get our heads around this whole political situation as well. So US politics, Fed policy, it's kind of what we do, right? We're all trying to understand risks. That's what we do as traders, is manage risk, and we're trying to understand when we should dial up the risk in the market by volatility, or what assets and what directions we should be trading on the back of that. So we're all risk managers, and the US policy, whether it's fiscal policy, political risk, or Fed policy, is at the backbone of that assessment.
So you said you're focusing on how the S&P would spill over or bleed into local markets in Australia, and a couple of those clips you cover the Russell 2000 small caps. We'll talk about breadth, but I'm curious if as somebody who's outside of the US, you find it more telling to look more at smaller cap, mid cap companies as opposed to multinational large caps, because if you're focusing on small cap companies, that tells you a lot about breadth and then internal health of the market.
I just want to see where the opportunities are. I want to see what's moving, to be honest. And everything's connected. If you see the Russell under pressure, you're generally looking down and you're seeing a big underperformance from the KRE, the regional bank ETF, and you generally spills over into the Russell. So for me as a trader, I'm looking for a vehicle to trade. I want movement. There's not a lot of movement in the market at the moment. Everything seems to be mean reverting and trading sideways, although there are some equity markets which are trending. We're seeing that quite nicely in the topics, the NASDAQ, not NASDAQ, the Nikkei, should we say. But I mean, for me, when I'm coming in the morning and I'm looking down, I'm seeing the Russell underperforming. Generally, it shows that there's a bit more life in the market. And I'm choosing a vehicle which I want to see and potentially trade, which is having a bit more life. And The Russell tends to have that. It's a higher beta market. We tend to see bit more movement in that. I mean, you can talk about how it derives its price, and a lot more companies there obviously taking its revenues from a more inward process, where obviously like the Nasdaq, a lot of the revenues are sourced overseas, and that's certainly the case in the S&P as well. So, you can put a macro focus on what's happening in the Russell, the health of the US economy, and those factors. We know it's obviously got a heavy skew towards US banks. But for me, I just really want to sort of paint a picture about sentiment. And I think the Russell, when you're talking about broad market sentiment, obviously you know about this better than most people, is when you're talking about broad market sentiment, the Russell's a key component of that situation. Generally see when the Russell's down over 1% at the moment, which isn't a particularly big move, but we're obviously in a low vol environment. If we're to see that underperforming, then you're going to see a situation where bond yields are probably having a bit of a move. Risk aversion coming through in the sectors. You can go into the S&P, you can see cyclicals underperforming defensives. You can see utilities working better, and it's all sort of been connected. So the Russell's always a pretty good guide of where to start at the moment, because obviously banks are one of the big prevalent macro thematics that we've been watching and been trading. So I think the Russell's a key component of that sort of macro jigsaw. Wouldn't you agree?
Yeah, and certainly it's been where there's been a lot more movement. I mean, I think I've myself argued that I think a correction started just based on intermarket work I do, around the third week of April, and small caps are not able to get any kind of traction. Regional banks, to your point, okay, maybe they bottom, but they're not certainly trending up. At least it doesn't seem like it. So it's been challenging to play any trades short term in the U.S. I want to get your thoughts on Japan, though, because there has been this interesting divergence, and it's been kind of, I think, underreported in the States. I saw CNBC was doing some quick coverage on it. I'm pulling up the chart of the Nikkei as we're speaking. You're not obviously at the breaking through the highs, but it is an interesting dynamic. As I recall, with the Nikkei, a lot of the stocks are also zombie banks. Maybe I'm wrong on that. Correct me on that. But what's going on with why there's momentum in the topics in Japan?
Yeah, I mean, it's not one our clients trade as much, but I think it's come onto their radar as well, because people switch strategies from momentum, and they're probably finding more momentum in Apple and your sort of MAGA stocks at the moment. But at an index level, there's not a huge amount of stocks that are making higher highs and actually showing some reasonable rate of change. But if you have a look at the Nikkei, and that's what they tend to trade, is the Nikkei, certainly not the topics, although the institutional crowd will always look at the topics because it's market cap weighted as opposed to a price weighted market, which of course is silly. But I think if you look at the Nikkei, it's kind of come back on its own. And there's a number of reasons why it's doing well, right? I mean, obviously, they've just come out the back of reporting season. We've seen good cash flow generation by a lot of the companies. And we've seen, I think, dividends have increased about 14% year on year. So that's been fairly attractive. The actual Japanese economy, we've just seen the GDP numbers coming out, I think, 1.6%, which isn't hardly breathtaking by GDP standards, but it's something that's actually growing in this world, and it's actually far better than expected. I think if you look at the economy in Japan, the wage numbers there, you've seen a period of wage negotiations. Wages were, I think, 30-year highs. You've got tourism, which is bubbling along quite nicely as well. So that's obviously benefiting a lot of the inward companies in Japan. So there's a lot of good things to focus on, especially when you've got a central bank at this point. And I say at this point because we are expecting tweaks to yield curve control probably in the July meeting, maybe August, but certainly July meeting, that they could look to tweak where they're focusing that yield curve control perhaps from 10 years into 5 years, and maybe that's going to cause some gyrations in JGBs. But for now, they've still got a relatively uber dovish central bank relative to anyone else. And of course, that's quite a good situation to be in. I think the fact that Warren Buffett went over to Tokyo in April and came back and said that he was buying Japanese stocks was something that caught notice with the market. And, people have been sort of wading in. And if you look at fund flows that have been reported in Japan, we've seen significant, I think nearly $40 billion worth of inflows into Japanese equity funds and future funds over the last 5 or 6 weeks. And of course, that's creating tailwinds. Now, of course, that's not going to go on forever. You're not going to get inflows like that at that pace for a long period of time. And that suggests to me, would I want to buy the Nikkei at these levels, or would I want to wait for a bit of heat to come out of the market? That would probably be where my suggestion would be, because the risk reward at these levels probably has become sort of asymmetric, I guess. But that's where you've gone. I mean, you've got the technical side of things where the market's going up, and you've seen CTAs obviously adding length into futures, and they're probably max long at the moment. You've got a market that's been working well. Everyone likes to buy high and sell higher, and you've got a good fundamental story. I mean, you've seen those inflows. You've seen good economy, and you've got the central bank, which has been relatively dovish. I think that's why you've seen that big outperformance in Japan this year. Whether it can continue, as I say, is one I'm skeptical. And people saying, "Oh, yeah, Chris, it's a yen effect. The yen's been underperforming because people in the FX market want carry at the moment. Carry is king." Well, yeah, and price the Nikkei in US dollar terms, and it's still breaking out. I mean, the gains are less prevalent, but you are still seeing a market that's working in all currency terms, and that shows good momentum. So I'm not someone who looks at the individual companies per se. I look at it at an index level or a futures level, and it's doing all the right things. And that's kind of why it's come onto the radar. So big fund flows, and whether those continue is yet to be seen. But I'm a bit cautious. I wouldn't be shorting it. I certainly wouldn't be shorting it, but I wouldn't be putting new money to work in a directional trade right now.
And you get a sense that those flows are simultaneously hedging out the yen movement after the volatility from last year?
Yeah, I'm not privy to that data, to be honest. I mean, I think that's something that we do look at with a lot of the Japanese companies, the big multinationals that you see there. You always look at their hedging ratios. They usually sort of sit around 65%. And that gives us an understanding every year they come out at the big multinationals. This is sort of talking about outward investments as opposed to sort of what's going on in domestic markets. But I think, the hedging ratios of companies when you're talking about these investments are really important. And, every year when we get those hedging ratios from Japanese companies, you tend to see a little bit of a gyration in the Japanese yen. But in terms of, someone like Warren Buffett, what would he be doing with Japanese companies? I mean, I guess he'd be looking at hedging a large portion of that yen exposure out, and that would have obviously big implications as well. But I see the yen as being something that has upside potential. I'll be obviously just interested to get your thoughts on this at the moment. The yen's been a hard trade. It's been quite frustrating for a lot of people. And I do see risks that if you pull up a daily chart of dollar yen, we've seen big resistance into 137.70. That's, really since the back end of sort of November, we've seen the markets fail at that level time and time again. So that's the kind of level that we're targeting at the moment, and one really for the scalpers where you'd be looking at levels to sort of fade into. But I would be expecting the dollar to continue to appreciate. So obviously that impacts someone like Buffett's thoughts on hedging, and I'm guessing he's not sitting there on the short terms looking to scalp dollar yen. But I do see some upside in the short term in the US dollar. I guess that's something that we can talk about at length throughout this podcast. But I think if you are investing in Japanese companies or Japanese index, then obviously there's a massive consideration about that hedging situation. I do see a situation where the yen will start to look good, and obviously that could come into its own if we were to see the debt ceiling becoming a volatility event, because the Japanese yen is something you want to own if we were to see the debt ceiling kick up some proper vol. But for now, carry is king, and I think the yen probably shows some short-term weakness at least for the next couple of weeks. So that's something that you do need to consider if you are buying Japanese markets. But ultimately, with any asset, of course, you want to be buying an asset in the weakest currency. And right now, the Japanese yen's not a particularly appetizing currency. So I would probably be doing it unhedged or partly unhedged in that situation.
I just think it's just funny how markets work. At the start of the year, the narrative was the place you want to invest in is China because it's reopening, right? And instead it ended up being Japan, right? Which is just funny how that plays out. But speaking about China, since you're in Australia, I think it's worth kind of exploring the role of China on your markets in Australia. And I remember in the midst of that kind of super commodity cycle, the early to mid 2000s, there was a pretty good relationship between China commodities and Australia, right? From a metals commodity perspective. Is the link between China industrial activity and the commodity sector in Australia as strong as it used to be, or are the two countries more divergent than before?
Yeah, I mean, if you read any newspaper, you'd see an argument that Australia-Sino relations are nowhere near where they used to be. However, if you look at the recent import data, obviously the world got a bit of a fright once we saw that import data the other day dropping 8-9%. But if you actually go into the imports from Australia, they're still holding up pretty well. We've got this great relationship where we are a significant LNG producer. We are one of three primary iron ore producers, and China has to import iron ore from Brazil or Australia and other countries, but certainly from a geographical perspective and a logistical perspective, it still holds up pretty well. So we produce some of the best quality iron ore, and China knows that. So they've cut back on things like wine imports and other factors over time, but the imports, things like iron ore and LNG and copper are still holding up pretty well. And so who holds the sort of leverage out of those two sides? Well, of course, China does, but they still need our products. And I think that will never break down. So I think it's going well. And I think when you're looking at a trading vehicle to look at, people look at the Australian dollar and say, what are the RBA going to be doing with rates and factors? But we have a rates decision, and we see some tweaks in terms of rate settings and what happens in front end yields, and that has a bearing very short term in the Aussie dollar, and most people sort of trade it against the Kiwi dollar and against the crosses. But then pretty much as soon as that's happened, then people revert back into trading the Australian dollar as a proxy on China. And that's really what it is. So when you're looking for vehicles to trade China, obviously it's very difficult to get your money and trade domestic stocks. So we tend to trade the CN50, we tend to trade the Hang Seng, the H shares and all those factors as a proxy on China equities. But when we want to sort of talk about what's happening in China liquidity and economics more broadly, we either trade copper or we trade the Australian dollar. And the Australian dollar has just been, the correlation with dollar CNH has been picking up. So what we've been seeing last few days is the dollar starting to strengthen against the Chinese yuan, the offshore one traded out of Hong Kong. And as the yuan's weakening, we're seeing the Australian dollar weaken as well. So the correlation's really started to pick up. If you look at the 20-day rolling correlation between the Aussie and the yuan, it's started to pick up. So for me as a trader, I say to myself, I want to express a view on China. What's the cheapest way of doing it? And right now, it's far cheaper to trade the Aussie dollar than it is to trade the yuan. So that's kind of what we do. So look, the relationship's still pretty strong, just to answer your question. But if you want to trade, a view on what happens with China, of course, you just choose the cheapest vehicle. And I think, whilst we can look at RBA rate settings, at the end of the day, the macro markets just know the best way to do that in G10 is just through the Aussie dollar, and that continues to be the case.
Let's go to a question. Again, if anybody wants to come up and ask questions, click that bottom left microquest button.
It's actually a really fascinating question. I'm not the best person to answer that question. Anecdotally, I think the Australian companies are probably the people who'd want to speak to this. So your BHPs, your Rios, your Fortescue Metals of this world. And I think at the end of the day, shareholders would want them to do business with as many people as they could possibly do. So I think that has a big bearing on it. And we're coming to a situation where production numbers will matter there as well. Someone like Fortescue Metals sells, I think, 95% of its iron ore to China. But from a political perspective, and it's not something that you read about it in the papers, and it's not something I get too concerned about. I guess from a superficial perspective, from a very cosmetic perspective, they've got to be seen to be pleasing everyone. You can't bite the hand that feeds you at the end of the day. And China, is our biggest trade partner. 35% of exports go to China. So I think you're always going to get a situation where Albanese, the Prime Minister, is going to show a very favourable face to Biden and a preference with the relationship with the US. I think that's very clear that's the case. But, with China consuming 35% of our exports, you still have to, you can play hardball and you can play, the tough guy. But at the end of the day, we would lose. Our economy would collapse if we thought that China were going to go elsewhere for these commodities.
You had mentioned earlier, you had addressed this point that a lot of the markets that people tend to trade for momentum haven't gone really anywhere, right? In the last month and a half, S&P obviously has been a whole lot of chop and largely sideways, a lot more action on the small cap side. What's going on in terms of just sort of the mechanics of the market currently? There's a lot of people that would argue that the market is, in quotes, pinned because there's a lot of hedgers already positioned, right, for downside. Is there validity to that? And is that a uniquely U.S. phenomenon? In other words, is there hedging going on in other global markets, or is it really just in the U.S. where there's that kind of floor, you can argue, that's there?
Well, I can certainly speak to the US side of things, and I think that flows through into a lot of the other markets. I mean, we can talk about the divergence you've seen there in the Nikkei, and long-short strategies have worked quite well. But I think if you look at the S&P in isolation, I mean, everyone's tried to buy volatility and they've got burnt. It's been a tough trade buying volatility. And so I think people have just refrained from doing that. And, you've seen a situation where realized volatility, 10, 20-day realized volatility is coming in so low that there's just no real reason to buy implied volatility. Straddles, strangles, all those kind of strategies have just been a tough trade. I think what we're hearing and what we're seeing anecdotally in the level of gamma that the dealers have at the moment in options world is that funds are using this low realized volatility world to sell calls effectively. And whether they're just taking that premium and enhancing the yield in their underlying positions is one thing, or whether they're using that that premium and buying puts effectively and having a free hedge against that situation. So you can maintain your equity holding, but effectively use the low volatility to override that situation. Of course, that's something that we had as we went into the pandemic, and it was unwound pretty quickly, and that caused an exasperation of volatility playing through. But we've got an options expiry this Friday, and there's a decent open interest around 4,100 in the S&P. So if the street is selling calls, then the dealers are buying them. And that just creates a mean reverting situation in the market in itself, right? So, the market moves down, dealers come out and buy futures, market moves up with any kind of strength and dealers sell. So that's why we've got markets pinned to sort of this 41.30 level in the cash. Whether, the market can move around a bit more freely once we've got this options expiry over on Friday with some of that gamma will roll off. Something like 30% of the gamma will roll off. Maybe the market can move freely until we get into quarterly expiries is something we're watching. But, the market is hedged. I mean, we've looked at skew. So we're looking at, say, like 1 month implied volatility in puts relative to 1 month call volatility and normalize that to at the money. And we've seen that moving up very sharply over the last couple of months. So people have used, they've been relative buyers of put volatility. So that's one factor. You can go and have a look at the GLD, obviously the gold ETF, and you can see that put call ratios, are through the floor at the moment. So, people have been massive buyers of calls upside in gold. They've been buyers of upside in TLT in terms of price, that put call ratio there. And you can also see that in the internals. I know you're a big, viewer of internals, and you can see that cyclicals have been underperformers versus defensives, and utilities have been outperformers. So people have been positioned in that side of things. So, there's a whole raft of factors that have been playing through. But I think the market doesn't want to sell risk. I mean, they don't want to short risk at the moment. To go outright directionally bearish has been a tough trade. So you can use this low volatility to enhance strategies, get a hedge in, and ride out the positions either for income in the positions you're in. But to remove those hedges and just go outright short has been a tough one. We tried that doing it in March when the banks all started really blowing up, and then the Fed stepped in with its credit facilities, of course, and those shorts covered very quickly. So I want to be in a position, I love volatility, and I want to be in a position where the market turns outright bearish and we see move back into the sort of the lows we saw back in March. But right now, everyone's hedged. Everyone's expecting volatility, but no one's prepared to trade it at the moment. So that's the question, is what could cause a significant spike in volatility? For now, we've just got a mean reverting market. So, if you look at the strategies that everyone's trying to buy breakouts, those breakouts have failed. And so you're basically selling strength and you're buying weakness. It's been a pretty predictable trade for now, and I think it continues.
Yeah, and it's been very. It's funny if you just look at a series of charts. It's like a lot of the major asset classes are either at the top end of the range or the bottom end of their range. So gold looks like it wants to break out. Small caps look like they want to break down. The S&P is at the upper end of the range. And, so it's like there's a lot of. I've made this point before. We're in an environment where it's not like a rising tide's lifting all boats. It's like many different markets within a single asset class, which makes it unusual. The irony is that I'd argue that's actually what a stock picker's market is, because only a few stocks are holding the headline averages, while a lot of other things are kind of
Well, that's right. When correlations break down, and volatility creates correlations across markets, but also in stocks, right? So when correlations break down, then you can go and pick those stocks. At the moment, of course, everyone's been just getting involved in Apple, in Google, and Microsoft, all those. They're the flavor du jour, and they have been for a while, right? And they're kind of your recession trades to an extent. But they've also done well because, you talk about this, but the 2-year Treasury has just been trading in a range. That is your poster child of range. We're trading, 433 into 370, and it has been, really since March. Until we see some rates volatility, I think that's really the driver. With swaptions, 3-month, 10-year swap, 10-month swaptions have come down. The MOVE index has come down. But one thing I will, and I don't know if you've looked at this, Michael, is real rates. So you were seeing a bit of a move overnight in gold to the downside, and the dollar's had a bit of a pop. Not so much against the euro, but it's certainly against the high beta currencies. And one thing we are watching is if you look at 5-year tips or real rates, effectively they're trading at 1.39%. They're trading right at the top end of the range that they've been in. And it's interesting because some of the data in the US has been poor and concerning, but then there's other points which suggest that the market's underpricing a June hike with 3 basis points. But we've started seeing real rates starting to move up. And I think if we were to see a bit of a breakout in real rates, and that pushes above 150, and the rate of change, of course, is always key in that situation, I think that could be really important for the volatility trade. Yeah, it certainly would it make me turn short-term negative on gold, and we'd see the US dollar probably push up, certainly against against the low-yielding currencies, and maybe against the cyclical currencies as well. So I don't know how closely you've been looking at real rates, but if you look at 5-year real rates, it's just stuck its head above the precipice and says, yeah, I might want to have a little bit of a run here. And I think if real rates start moving up, then I think that can have big implications for global markets. Have you thought about that one?
Yeah, well, I would actually argue that's consistent with risk off. I mean, if that happens, because it would suggest that there's been a degree of over tightening. You can't have positive real rates for any prolonged period of time with how much leverage there's in the system.
Correct. I agree. I agree. I mean, it's the real cost of capital, isn't it? So if real rates are going up, the US dollar's going down, and if those two factors are happening, then yeah, well, you'd see volatility pick up. And the thing is, volatility, obviously, it manifests in itself, because what you then see is all the volatility dynamic funds. Yeah, they start taking cash out of the system. They take cash out of the equity market, and you see volatility breeding manifest into high volatility. So yeah, I agree. I mean, you're not going to have high real rates and a high dollar and not have a risk off situation. The question is what would be the thing that what would you want to sell as that risk off thematic?
Everybody, please make sure you follow Chris Weston here on Twitter. If any of you want to come up and ask questions, click bottom left on the mic. And as always, this will be on all your favorite platforms under Lead Lag Live.
Yeah, I don't follow Australian corporate regulation or Chinese regulation on corporates. There has been some stories. It hasn't been anything really in that we've had to follow, to the extent of, Chinese companies listing in the US and those factors. There hasn't really been anything that's really pricked our attention for quite some time. The Chinese are big buyers of properties. I mean, it's more about the regulator around Australian housing is one that we saw, really dynamic. Certainly, if you look at what happened, one of the things that really hurt the property market when we came out of the pandemic was that we had a regulation on overseas visitors coming over here. And the Chinese are massive buyers of property in Australia. One of the things, I'm not a property expert at all, and there's people who can obviously lay this one out far better than I. But what you've got to think of is why the Chinese buy property in Australia. Is it because they believe that they've got this kind of positive expectancy around house prices always appreciating? Perhaps. I mean, it's made known that we have this very strong feedback loop in Australian housing, probably stronger than any other market. China's markets, obviously, the Chinese is very strongly. Yeah, but the way that you've got to think about it is the government have a vested interest in keeping housing supported. I mean, we've seen the cash rate going up to 3.6%, and we've just seen this fiscal wall of concern as people roll out of fixed mortgages into variable mortgages, like a lot of other places. But yeah, so you've got this positive expectancy that house prices will be supported, and I think that's one reason. But the other thing that we would all remember, okay, all of that stuff is going to be supported, but are they actually are they getting their money out of China for speculative purposes, or are they finding vehicles and ways of getting money out of China because of the closed capital account? And for years, it was an easy way for people to get money out of China and put it into places, because they had these property visas that you could get where you could actually invest money. So I think part of the reason is you had the positive expectancy on commercial property and certainly residential property, but also for a large portion of time, if you wanted to get money out of China, the government made it quite easy to do so, and you could buy properties. And I think that was one of the major contributors towards those situations. Now, they've tightened that up a little bit, but I still think it's pretty easy for Chinese individuals to buy property in Australia and move money out of China. Yeah, but anecdotally, you can go into any the big shopping centres, and there's these booths that people have out there, advertising, tourists to come and buy property, and invest in commercial. They're just purely targeting Chinese. So yeah, I think that's something that will continue to be the case. But yeah, whether we see far tighter regulation, I'm not sure, because it's a great support for the property market, which, as I say, is you will lose an election if the property market gets hit too badly. If the Chinese, again, this is not my area of expertise, but yeah, if the Chinese the government were to say if they need to manage their overseas investments, and there was an implication of having to pull out, it would have a significant wave on Australian assets. I don't know I have no comment on whether that's going to happen, but yeah, there's no doubt. If there was ever a situation where they said, right, you need to bring that money back home, or there's going to be curbs on overseas investments, yeah, it would cause waves across the Australian market for sure. I'll do some digging on that one, but yeah, it's not something that's necessarily hurting our market. I mean, if you look at, again, this is sort of coming off topic, but if you just take prices or sort of a leading indicator, I mean, Australian property had a sort of a 10% correction the last few months. It's actually stabilised, and it's actually working quite. It's started to find a gradual grind higher. Now, whether that changes because people are betting whether or not the RBA could raise rates again to something. But yeah, auction clearance rates are okay. Yeah, there's no real signs that people are concerned about a significant buyer potentially being pulling away from the market or being forced to sell. So yeah, we're not seeing that any signs at the moment.
Speaking of coverage, just on that point, I'm curious, Chris. Just given you're again in Australia, what's the coverage been like when it comes to the debt ceiling? I mean, I'm going to assume that media in the U.S. is probably similar to media in a lot of other places, and that they tend to sensationalize. But how do you get a sense of what's kind of real and what's not, just in terms of local sources when looking at the U.S. markets?
Well, I think it's just starting to catch on, to be honest. I mean, we're very lucky because, obviously we all know the end. We all know how this how this rectifies itself, and we know the outcome ultimately. But getting to that point is something that public policy experts don't really know the answer to that one, to be honest. But yeah, I think it's starting to now. The press is starting to catch up. You're starting to get more articles in local press saying what happens if the US was to defer a payment or ultimately miss out on paying one of its bond obligations. What does that mean for Australia and all those factors? And I think people are looking at an outcome that's obviously a very low probability and looking at that worst case scenario. That's kind of what they're focused on at the moment. It's not about how they get to this agreement, what that agreement looks like, ultimately what's going to be the fiscal drag from that agreement. It's not going to be about when the debt ceiling has been agreed for 2 years or potentially that's sort of base case relative to the short-term extension. What's going to be the implication for the Treasury General account once the Treasury allowed to go and assign $1 trillion worth of bills, and there's going to be a drawdown on reserves, and the private sector is going to be asked to absorb a lot of that, and that could be a big US dollar. It's my base case that could be a big US dollar positive. So we're not focused on all those factors. We're not focused on could Kevin McCarthy lose his tenure as the speaker? All those factors. It's really at this stage the local media is like, what happens if the US defaults? And what could that mean for the global economy? So that's where we are at the moment. And then you might get some people who are sort of ingrained and actually sort of quite enjoy the brinksmanship and how it gets that to a point of agreement between the Republicans and Democrats. I am fascinated by the subject to my detriment. I'm sure there's a lot of people on this call going, why on earth would you pay so much attention to that? But, for me, we are assessing the checklist of risks that could cause a significant volatility event. We focus on things like, could the banks could it be systemic? Obviously, it's not at the moment. Is there something that could cause that? What happens if the Fed were forced to raise again? What happens if we saw a far faster economic slowdown? And the Fed will have to pivot. What does that mean for markets? So there's all these kind of scenarios, but the debt ceiling is one that is a massive known unknown, and we are looking at the probabilistics of of a payment being missed as we go into that early June period. We've just seen the cash balance effectively of the Treasury coming out of dropping another 52 billion overnight. And that's, getting to very low levels indeed now. They're drawing down the extraordinary measures as well. And I think everyone's trying to understand is how much cash will they have in the Treasury General account when we get into that first 2 week window, knowing that they're going to have to make a sizable payment for Social Security and for Medicare. And will they have the funds to do that? That's kind of where we are at the moment. That's where I'm assessing. And ultimately, what are the markets that we want to look at to say that the market is now seeing this as a volatility event? We all know at the moment it's all confined into bills. There was a bit of a move in CDS recently, but that's kind of plateaued out. But all the stress has been in the bill market maturing in sort of, the first to, I suppose, the sort of 29th of June. But all the other indicators that we're looking at to give us a sense that the market's prepared to trade the debt ceiling, things like, implied vol in the FX market, gold implied vols, we're looking at credit spreads, all these things that would say to me that the market's now seeing the debt ceiling as a proper event. We're not seeing that at the moment. People are hedged, as I said earlier on, and people are just taking us out in the bill market. And you've seen that 1 month bill relative to SOFR OIS effectively widening out to about 40 odd basis points. But at the moment, we're doing our due diligence. And I think people who are actually market participants are obviously looking at this very closely and looking at the risks and the dates, the different probabilities. But I think the everyday citizens out there who are not heavily ingrained in risk management, obviously, as I say, they're just looking at the situation that what happens if the US defaults, which is, as you and I know, is something that probably is around about sort of 3-4% or so.
Are the Aussie bond markets, government sovereigns, responding in a co-movement way to U.S. treasuries, or is it isolated just to sort of volatility in the U.S.? I mean, it's more than just the argument of, global markets follow U.S. stocks. I mean, global yields follow treasury yields still.
Yeah, no, exactly. I mean, if we look at 3-year government bonds, which is kind of like the one that we sort of look at as more sort of, we look at that over the 2-year for our front end. And that's been doing something very similar as the US 2-year. So we've been trading in 3.2% down to 291. And I think, from a central bank perspective, what we don't have is the level of rate cuts that you guys have got priced into Fed funds or into swaps, 80 odd basis points being priced in by January. We don't have that. But what we do have priced into our rates market is the RBA, the Reserve Bank of Australia, being on hold, and then this kind of higher for longer mantra being priced in. And I think you've seen that in the front end of the curve. So, the spreads against US bonds have not really done a huge amount. But I think they're basically doing the same thing. What I would love to see, and what we saw last year, was when the US was having its sort of exceptional story, and the Fed were raising rates far more aggressively than other banks at the time, is what you saw is those yields blowing out and US treasuries, trading at an ever wider premium relative to other bond markets. And that's what I love, because what that does is that creates trends, capital flows into those markets, and it creates really strong trends into FX markets. It's why CTAs did really well last year. They had the best year on record, because you saw that massive divergence in yield spreads. We're not seeing that this year. I know if you go and look in Europe, you can see that German bonds and US treasuries, the euro dollar has been trading that one very closely indeed. So relative rate policies still matter a lot. But what we're seeing now in Australia and the US is that we've basically got nothing being priced now, and we've got a central bank that's on hold. And what we're doing is we're waiting for new information to come in to say that the RBA needs to start raising again. They can keep the policy rate here for a while, or maybe they need to start easing. But we're in a kind of hiatus at the moment, waiting for new information to come through. But the Aussie bond market's just doing the same thing as the US bond market. And that, again, that's probably part of the reason why we're seeing such low volatility, both implied and realised in the FX market here.
Gotta love diversification when everything moves the same. I think the frustration. Maybe for the last few minutes here, Chris, I want to just get your thoughts on Europe, and if there are some interesting opportunities for those that want to take more of a long buy and hold type of position. We all know the Eurozone tends to be a basket case, but since all the parallels are to 2011, people seemingly are forgetting that the other dynamic with the debt debacle in 2011 was the Eurozone crisis, right? Every day, it was a question of, will the Euro survive or not, and all the back and forth, right? It was kind of it was much more than the S&P downgrade of U.S. credit quality. Any interesting observations when it comes to different parts of the Eurozone that look maybe particularly attractive, that could have its own Japan-like divergence moment?
Well, look, I think you can play long shorts, long European banks, short US banks. That's been working quite well. Even when you look at it on a currency basis, it's been working really well. So people have obviously focused on Credit Suisse, but take that out of the equation. A lot of people have been looking at the better fundamentals of European banks, and they've been long. You can have a look at the EUFN, which is the European Bank ETF, and go short the XLF. Whether that trade has more juice is yet to be seen, but that's been working really well if you want to trade the relative banking sectors. What I will say, though, that makes me cautious on putting new money to work on that trade is if you go into late June, a lot of the European banks borrow a significant amount of money, what they call the PEP program, the Pandemic Emergency Program. And a lot of those repayments are going to have to be made in June. I think something like over $500 billion, €500 billion has to be paid back. They are accelerating the asset purchase program buybacks as well. And so that's a big situation. So these banks are going to be asked to pay back $500 billion worth of euros of these loans. And we haven't heard a great enough discussion about potentially a bridging facility, because that's a huge amount of duress that needs to come off these banks' balance sheets. And so we will be looking at things like European bank credit default swaps and those factors as well. But I think what's interesting is, you can take a view on China, because part of the reason we got so bullish on euro and why we saw euro push into 111 is because China was improving, and Europe and the US are major trading partners. And so, China, if we have seen that for the best days of the reopening trade, and we are going to see a slow, gradual grind lower in some of its economics, that's going to hit Europe. It already is. I mean, we've already seen some of the European economics under pressure. Industrial production numbers in Germany were poor. We saw their own SLU's report effectively coming in, showing a tightening of credit conditions. Factory orders have been under pressure. And we saw ZEW confidence numbers coming under pressure, survey under pressure. So, look, I'm concerned a little bit about Europe. It's not a basket case, or it's not something that flashes red and says short the bejesus out of European assets at the moment. But when we're looking at relative growth rates, which we love, we want to be involved in the place with the best growth rates. Europe's seeing a bit more fragile than other markets at the moment. You've seen that in things like the Citigroup Economic Surprise Index, for example. You can see real weakness in Europe relative to anywhere else. So European data has been consistently missing expectations by a number of standard deviations relative to a lot of other places. So, if China was to slow down a little bit, not collapse, obviously it won't, but if it's slow down, if we've seen the best of the credit growth there, and Europe faces this wall of maturities of paybacks, then I expect European markets probably to underperform. So banks which have done really well may start underperforming US banks. I think you may see some better downside in European equity markets. And I certainly think it probably suggests, with slower growth and with the ECB still to raise rates, that stagflationary light environment suggests there's probably some trades to on the downside in Europe. But at the moment, the best way to trade that with low vol is to do a pairs trade. I think long-short strategies work well. So taking a cautious view and shorting Europe and offsetting against other markets is probably where we'll be looking there. Yeah, it's a good question. I mean, for me, the market still doesn't react a lot to Chinese data. I mean, it's something, compared to, I'm sorry, this is a bit long-winded answer to your question, to be honest, so bear with me. Yeah, so I mean, if you look at the reaction in markets to payrolls, CPI, any central bank situation, it's obviously a position that's unwound very quickly, and then obviously new insights, and you see a short, sharp movement. You never see that on any of the Chinese data points. Very rarely do you see the market positioned for something and then you see a big unwind. Take the trade balance numbers. We get disastrous numbers, but the market barely ever moves on it. I mean, it's terribly reported in the first place because, you get the yuan number coming out and then you can get dollar value, shortly afterwards. But the market never moves, whether that's copper, whether it's Aussie dollar, whether it's markets. Chinese equity markets doesn't look at the data. It just looks at inward liquidity and what the PBOC are putting out. But all the sort of G10 proxies of China, they never move. And then I think, so the market is, it might be 6 hours later before you see a move and then the press come out and say, it's because of the Chinese data. So I think the market, and that's important to me as a risk manager, when I know, understanding how much, how I position myself over a news event and how exposed I want to be, how volatile it could be. The most important thing into there is that, rarely do you see markets move off Chinese data. What we look for and what we looked at after the reopening was a lot of the mobility data. I think that gave us some indication about what things were going to. That sort of fed quite nicely into things like, the credit data. It fed quite nicely into industrial production and those factors as well, fixed asset investments. So I think the mobility one is there. For me, what's more important in China is liquidity. And, what the PBOC are doing with, a median lending facility and the liquidity they're pumping out, that tends to be a bigger driver of Chinese assets. Now, you and I are looking at this from very different factors. You're looking at it from much more an economic situation. I'm looking at it from a markets perspective. And China's market, I know very rarely do you see a situation where global markets actually reflect the underlying economy. It's all about Fed policy. It's all about balance sheets and factors. But China is that place. And what matters more to me is what the PBOC are doing in terms of liquidity. And ultimately, what is the message that you're seeing out in the market? Because if you see message on front page, in Chinese media that, they want something to happen, they're taking a cautious view on something, people do that situation. So when I'm trading Chinese markets, I'm looking less at mobility data and electricity prices and all the stuff there around it. And for me, what is more important is liquidity dynamics and the message that you're hearing from the PBOC, because what they want from policy, if they say we want a much more restrictive, people go out and straight away sell Chinese stocks. That's to me is the bigger driver of markets there.
Yeah, that's a good place to wrap this Twitter space up. Chris, for those that want to track some of your research, some of your thoughts, aside from Twitter, where can they go to?
Well, I do write a bit about sort of stuff I'm seeing, and you can go to my Twitter handle and you can see a link to sign up for that. It's free. You won't get a call from anyone. It's just a few views on what's going on in markets that you can follow there, or go to my website, pepperstone.com, and you can see some work there. But yeah, mostly it's on Twitter.
Thank you, Ray, for joining. I am now going to get some sleep. Thank you, Chris. I really do appreciate your time here.
Pleasure. Thanks for everyone for listening.